So recently, the central bank's MPC committee has announced a rate cut. So today we'll be talking about the same. Now, what has the MPC decided? The central bank's monetary policy committee (MPC) acknowledged a sharp slowdown in investment activity, along with a continuing moderation in private consumption growth, as a matter of concern. As a result of this, the Reserve Bank of India cut its policy interest rate by 25 basis points in a widely expected move on June 6, while also changing its policy stance to accommodative after latest data showed that economy growing at its lowest in over 4 years. The repo rate, the key interest rate at which the RBI lends to the banks, will now be 5.75%. The rate cut decision came after the MPC concluded its second bi-monthly monetary policy review for 2019-20. The decision of the rate cut was unanimous by the 6 members of the MPC. The MPC revised both its growth and inflation forecasts for current fiscal GDP growth has been revised downwards to 7% from the earlier projection of 7.2%. It identified the headline retail inflation to have been inched up by a mere 6 bps in April to 2.92%. While this was the highest inflation print in half a year, it has a 9th consecutive month in which the retail inflation, as reflected by the Consumer Price Index, had come in below the RBI's medium-term target of 4%. According to the RBI policy statement, risks around the baseline inflation trajectory emanate from uncertainties relating to the monsoon and seasonal spikes in vegetable prices, international fuel prices, and they pass through the domestic prices, geopolitical tensions, financial market volatility, and the fiscal scenario. Now, why has the RBI turned accommodative? The overall tone of the monetary policy document conclusively suggests that MPC's focus is now shifted towards boosting growth through rate cuts, and inflation is no longer the near-term priority. The MPC noted that growth impulses to have weakened significantly as reflected in a further widening of the output gap. These concerns are valid on the growth front, as the gross domestic product (GDP) growth rate has been falling in consecutive quarters for the full fiscal year 2019. GDP fell to 6.8% as compared with 7.2% last year, dragged by poorly performing manufacturing and agricultural sectors. Consumer demand is subdued and unemployment is at a 45-year high of 6.1%. India grew at a much slower than expected 5.8% in the last quarter, far below the pace needed to generate jobs for the millions of young Indians catering to labor market each month. So what are the hurdles in front of the RBI? The Reserve Bank has cut its policy repo rate, but there are grave doubts whether the full benefit of the rate cuts will reach the industry and consumers and help to push up the growth rate, which has hit a 5-year low. Analysts said that the poor transmission of rates was a major challenge before the RBI governor. Banks have put the blame onto tight liquidity conditions for the inability to reduce the deposit rates, which leads to lower lending rates. Besides, a large portion of the deposits are held as fixed deposits where the interest rate cannot be reduced frequently. A cut in the repo rate only lowers the incremental cost of funds, but the overall cost does not come down because of the presence of fixed deposits. They've also cited the competition from small savings schemes that offer high return and constrain them from cutting their rates. Some feel that the RBI should maintain surplus liquidity conditions to bring about effective monetary policy transmission. Another big question is whether even another 50 BPS rate cut will be enough to lift the faltering economy to a safer place until the manufacturing segment picks up and private investors return to the country. And here, it's not just the cost of borrowing, but a host of other issues that are posing hurdles to the growth recovery, the absence of land and labor reforms being one example. Now, where should the real growth push come from? Prime Minister Narendra Modi on June 5 ordered the formation of 2 new cabinet committees that will focus on employment and economic growth. The committees are constituted under PM Modi's chairmanship. The latest development comes close on the heels of a report by the Periodic Labour Force Survey that showed India's unemployment rate at a 45-year high of 6.1% in 2017-18. The report was released on the day Modi took charge as the Prime Minister for the second consecutive term. It was imperative as from more than 9% in the last quarter of 2015-16, the growth rate pounded by the surgical strike of demonetization kept falling for the next 6 quarters, reaching 5.7% in quarter 1 of 2017-18. To put this in perspective, a drop in the GDP growth rate means the failure to generate wealth from the country, thus impacting investment and job creation. All this is a far cry from the promised double-digit growth rates. In this second coming, Modi knows he has to deliver on the economy. The task is uphill and there is no time to lose and to wait. So with this, we come to the end of our video. If you liked our video, do share it and do subscribe to our channel.